I'm John Weber, and this is Global News Roundup, the program where we talk to the world's leading insurance journalists about the stories making news in their publications. Today we have as our guest Kim Lankford, a contributing editor at Kiplinger's. She joins us from our studios in Washington, D.C. Kim, thank you for taking the time to speak with us today.
Thank you for having me.
Kim, you recently wrote in Kiplinger's about the state of the long-term care industry and its impact on an aging baby boom population. Where do things stand right now in the long-term care industry?
Well, there's just been a lot of changes recently in the long-term care insurance business. Over the last few years, several big companies have gotten out of the business. They've realized it's too expensive for them to pay these potentially large claims. They end up covering their policies that they sold in the past, but decided not to sell any new policies. Also, several of the big companies have had rate increases. When people buy their long-term care insurance policies, there's never a guarantee that the rate will remain the same forever, but a lot of people who bought policies 10 years ago or even more had been paying the same rate every year, and were very surprised to get rate increases of sometimes 50 to 90%. And so a lot of those people are trying to figure out what to do with their policies, whether they should keep it, whether they should make adjustments. One really important thing for people who have policies is before you drop it and lose all that coverage that you paid for years to have, take a look at what you can do to readjust that policy. For example, you may be able to cut down on the benefit period. If you had lifetime benefits, may be able to cut down to 3 or 4 years, still have a lot of coverage, but lower those premiums if it becomes unaffordable to pay those increases. Also, you can make some changes to the inflation adjustment, especially if you're in your 70s and your policy has already increased in value a lot through the years. Some of those things can make it more affordable, and really think about what you can do to preserve some of that coverage, even though those costs are going up.
So, Kim, how did we get to this point?
Well, long-term care is a very, very expensive business, and the average cost of a nursing home right now is about $80,000 a year, and some are cost way more than that. So it's insurance companies who have been paying, especially those who have promised to pay lifetime benefits, ended up paying a lot more in claims than they had expected. People are living longer, but maybe living longer in a nursing home, for example, or needing home care for longer. And so the insurance companies that had promised to pay as long as the person needs care ended up paying a lot more than they expected. Also, when the insurance companies were first pricing these policies, they were assuming that a certain number of people would either drop their coverage or die before they ended up needing the care that would put them on claim, and that didn't happen in the way they had expected. So that's why a lot of the companies are raising rates, or some of the companies are realizing they just don't want to sell new policies. It's just a hugely, potentially very expensive business, and who knows, with medical advances, what's going to happen in the future.
Kim, what are some of the options for the consumer?
Well, the first thing is, for those people whose premiums have increased, look about your options. Talk to the insurance company about what you can do. It's especially as you're getting older, if you've been paying premiums for years and you're heading into your 60s or 70s, it's going to be much more expensive to buy a new policy now rather than to deal with a rate increase. Because not only have the companies had to increase rates on the policies that are already sold, but the new policies that people are just buying these days are much more expensive because they are factoring a lot more of these elements into their pricing. And regulators have gotten a lot more strict, too, about setting the prices at the beginning. So hopefully there won't be big price increases in the future. So if you do get a price increase, talk to your company about your options. See if there's somewhere in your cash flow that you might be able to pay for the additional premiums. But also look at maybe lowering that benefit period, maybe changing some of the inflation, so you still have a lot of coverage, but may not have coverage to cover the entire cost. You may still be able to pay some of that cost from your savings, but you may be able to still protect about $100,000 of potential costs with the policy. Another thing is, if you're looking for the policies now, like I said, they may be a lot more expensive than people were paying. They are a lot more expensive than people were paying several years ago. And a lot of people are kind of hedging their bets a bit. They are using the long-term care policies to pay for some of those potential costs. For example, if the cost of care in your area is $230 a day, which is about average, you may decide to look through your personal finances, figure out what savings you might have available to pay for potential care, and decide to cover part of that cost with a long-term care policy. So maybe buying a policy that covers maybe pay $175 a day or $150 a day. Or you may decide to limit the coverage to 3 years. Or one thing that married couples many times do now is called a spousal shared benefit. And so they can come together and maybe get a pool of a total of 6 years of coverage that can be used between the two of them. So if one person needs care for 2 years, the other person will still have 4 years worth of care. And that really is a great way to hedge your bets, because so many times one member of the couple may end up needing care, but the odds of both of them needing the same amount is small. So you've got that potential for longer care covered while being able to keep those, keep that benefit period a bit shorter than you would otherwise. Also, a lot of people are looking at other ways of covering the inflation protection. Some of the policies that are having the big rate increases now are some of the ones that have the 5% compound benefit increases. So every year your daily benefits would go up by 5% per year. And that ended up being very expensive for the insurance companies, but that was kind of the standard coverage up until very recently. Now some companies are offering 3% annual increases, or increases that are tied to the consumer price increase. So a consumer price index. So, they're tied to either the inflation rate, which may or may not go exactly with what long-term care rate increases are, but at least it increases the value of the benefits a bit each year. So all of those are some kind of trade-offs that people are making to make the premiums more affordable, but also providing a big chunk of coverage. A lot of people, the other thing is, are just looking at how this fits within their retirement savings and retirement planning. And more financial planners are getting much more involved in looking at the potential costs of long-term care when figuring out how much money people need in retirement. So that's where looking at maybe covering some of those costs with some of your savings, but then using a long-term care policy to fill in some of those gaps. That's a key trade-off that a lot of people are making these days.